everyone. We hope you enjoyed the break and are ready to dive back in. It's now time to make your pick and choose which breakout session you would like to attend.
For our hybrid event, we have in the studio ESG versus impact frameworks hosted by Kristin Siegel. In the library, we're going to be looking at different impact funds with our host Alexandra Nitzlader.
And our online audience can still join the masterclass with Anne Miltenberg on branding that started at 11 o'clock. To head on over there, just click Join Online Session right below where you switch your streams. And finally, we are standing in front of the session that's happening in the atrium that's only live here at Impact Hub, where Philip Narwal will guide us through how to create entrepreneurial communities outside of big cities.
So if you're joining us live, choose your room now. If you're online, this is the time to push the button. You can either join the studio stream, you can join the library stream, or you can join the online session.
So without much further ado, I think let's get it started. I'm off to the library to learn more about impact funds.
And I'm going to head over to the studio to listen to ESG versus impact.
Afterwards, we'll have another short break and we will meet back in the studio at 12:30. See you then. Bye, everyone.
All right, welcome back in the studio here in Vienna. Welcome back to the audience, online audience. I'm delighted to welcome you to our next session. Uli Grabenwerter said this morning, we must be mainstream. We are the only solution. But he also said, dilution is the problem. And diluting the problem will not solve it. I think this is actually a pretty good setup to our discussion now, ESG versus impact, or how I like to call it, ESG and impact. I'm Kristin Siegel. I'm representing the Toniic community over here in Europe, Middle East, and Africa. We are mainly high net wealth individuals, family offices, and foundations who are looking to invest all their wealth across asset classes into impact. And I'm really delighted to be joined by my panel today. On my right is Peter Jederberg. He is the CEO of JC Impact, joining us from Hamburg today. Welcome, Peter.
Thank you.
And also today in the studio with us is Angelika Delen, Head of Investment Consulting, SRI and Impact Solutions at Mercer, really one of the pioneers here in Austria, and I think the one who was really pushing impact as the first one. So welcome also on this panel. And then we have two gentlemen also joining us online. Welcome Klaus Kuns. He is the Head of Sustainability and Business Stewardship at Bayer Crop Sciences. I think you are joining us from the Cologne area. So really excited to hear your input from working at a company that a lot of investors are actually investing in, and to hear a little bit more what you are doing on the ground. And then joining us from Switzerland is Peter Zollinger. He's the Head of Impact Research at Globalance Bank in Switzerland. Globalance Bank is an owner-managed Swiss private bank that also advises private clients and families and foundations and also helps them to invest across asset classes. So welcome, everyone. Thank you for joining us. So I mentioned I like to say ESG and impact. We at Toniic do think that both are needed, but it is really important to not dilute them, to really clearly separate them. And so ESG plays an important role in the investment portfolios, especially for our investor members in Toniic. They do want to invest across asset classes. But it is really important to not call what an ESG investment is to say that it is impact. So we clearly need to distinguish it. And the way how we distinguish it is that ESG is really around how you do business, that you actually consider environmental, social, and governance factors in your investing. But impact is really about the transformation that we need in the society and the world, and it is about what we do in the company. So there is also a difference as really what the company is doing and what kind of impact we as investors can have. And I want to start first with Angelika. You actually did also a survey around transformational investment here in Austria and dived a little bit deeper into exactly the question ESG and impact. What did you find?
So first, I'm happy that Markus is now joining with.
I was standing outside. I didn't know that you started already.
That's fine. So basically what I'm going to tell you, it's a bit the theoretical part, what we find out. And hopefully Markus will then jump in with the practice about impact investing. Mercer is working with the World Economic Forum. And the team, my colleagues in the US, questioned the global asset owners about the global challenges. And what a surprise, on number one was climate change. On number two was, of course, a low interest rate. And the team worked out an assessment, so about 80 questions when it comes to climate change, from governments to processes, investments, etc. And we had calls with different clients from Austria, Switzerland, Germany, global. And one of the interesting key findings was that those who are thinking about climate change and that it is difficult to implement, they were struggling with all these different variations of ESG implementation. So on the market, there are so many, I would say, options how to implement ESG that based on the transformation investment and the global challenges we found out, that we never reached the point to impact to some of those investors. Those who already have their own ESG approach are thinking about the next level impact. So what is the difference when you look from the investment side between ESG and impact? ESG is considered as an additional risk analysis. So with ESG, you are able to monitor and filter out more risk when it comes to investment. Impact, you have a clear topic and aim to drive, or I would say to improve your investment. So you want to have a target. And what I see on the market, and that's why I'm pushing really, even if ESG and impact, you cannot, you have to do both. So ESG is a kind of framework before you can talk about impact. But the thing is, if you're doing ESG screening and you have your ESG rating, and then putting out a report and saying I'm driving impact, that's not impact. Impact means you have a clear target. So when it comes to the investment process, you have your financial analysis, you have your ESG analysis in order to understand your risk better, but you have to have a clear impact target. So you have to drive the impact, what you want to achieve at the very beginning of your investment process. And that's something I think we need to discuss in a broader way to get to the mainstream, because right now the people are still in the ESG framework and afterwards telling that we are creating impact. But impact really has to have, and that's very important that we have a clear impact target. So you have to know at the beginning of your investment what you want to achieve, what kind of impact you want to drive in order to say you have an impact investment.
Yeah. Absolutely wonderful. Thank you so much for sharing those findings and really making it clear what the difference is for you. Markus, thank you so much for joining us here on stage. Markus Zeilinger is the chairman of the board and founder at Fair Finance Vorsorgekasse here in Vienna. And I know that you also have been fighting for quite a while to launch a social entrepreneurship venture capital fund beginning of this year. So maybe you can share a little bit, what are you doing at the Fair Finance Vorsorgekasse and how do you differentiate ESG and impact?
Yes, thank you very much. Yes, I can sign all what you said, but that's the theory.
Yeah.
The practice is different. It's more gray. It's more gray, and all ESG vehicle providers say that they are impact investors. Yeah, and so you have a lot of, let's say, greenwashing in the market, and it's very difficult to find out and to see what's really the point, the core of the investment. Yes, that's very difficult. Yes, Fair Finance Vorsorgekasse is a severance provident fund in Austria. It's an obligatory system, and we are an institutional investor. Yeah? And as our brand says, Fair Finance, we are focused on ESG, sustainability, impact investments. And we have a very strict regulatory frame. So our impact investment part concerning real impact investments, I will make a definition of what we think that is. Yeah, is near to 40% of all portfolio. 60%, let's say, is bonds and listed equity. And in this part of the portfolio, we are an ESG investor. And the other 40%, we try to become and be an impact investor. What is this 10% of the total assets under management? We are investing into real estate with a special impact focus. We have created our own rating system. We are not only looking on the economic side of real estate investments, we are looking on the ecological side, energy efficiency, for instance, and the material, what's in there, the gray energy in the buildings, and of course the ethic part, let's say, affordable housing, and criteria like this. 10%, other 10%, we're investing into microfinance funds. We are not selecting let's say the banks or the partners abroad ourselves. So we are investing into funds. 10% is mezzanine capital, or last month we are moving to whole loan, and we are financing mezzanine capital in real estate, private real estate debt, and the other 10%. Now we are coming to what you are interested in, is, let's say, private equity or special topic funds, like how do you say, forestry and agriculture, and a very little part is the fund you mentioned. So we spent 5 million euro, or we have a reservation for 5 million euro for equity for social enterprises, for social entrepreneurs. We started this year this fund. I think it's the first fund of this aim, at least in Austria. There are some in Europe, and it's a unique fund in Austria. We made 6 investments until now. 2 more are, let's say, in the final stage. And I have seen some of our partners here. Yes.
Thank you, Markus. Yeah, so also good to hear that really you make this clear distinction where you say like 40% are in impact and 60% are ESG. So also for you, it's good to hear, you know, from you as a Vorsorgekasse that you distinguish that so clearly. So thank you for sharing that. Then I want to go over to Switzerland, to Peter. Globalance Bank, you have been one of the first sustainable asset management companies, and now also our bank helping investors invest across asset classes into impact. And you also said that the ESG rating agencies that are out there, they don't provide good enough data. So you actually created your own deeper analysis, and you launched actually a platform called Globalance World last year that also is open publicly on the website. Would be great if you could share with our audience today what you're doing there and how you are approaching ESG and maybe ESG plus and impact.
Well, good morning. Yes, that's correct. I think for the conversation, my contribution here would be the notion that any financial investment which deserves this name has an impact. Question is what this impact is and whether it's a positive impact or a negative impact. So at Globalance, we're a mainstreaming proposition so that anyone who is interested in impact applies this interest to all its asset classes, to all elements of wealth. And as individuals, we're not trained in school to be aware enough that as owners, we have this power or this responsibility to help direct the deployment of our capital. So yes, I think everything which has been said in terms of ESG being from the risk side and impact comes on top is relevant, but what is even more critical is that it's applied in a consistent way in all asset classes. And therefore, we had to go beyond the current available data set which is, ESG data, raw material, so to speak. When you look at the ratings and the complexity, that's for private individuals, families, and foundations, very difficult to access. As knowledgeable as we might be, it's done for specialists. And so we set out to find a way to engage asset owners in an emotional way. And the only way to counter greenwashing is to be completely transparent and to be completely accountable down to the individual position in a fund, which you might have in a mandate. So taking this together, we've used technology and have deployed the specialists in the digital world to help build this platform, which is a way, a Google Earth or a TripAdvisor for money. Basically, you upload your portfolio, any portfolio from anywhere, and you get an instant X-ray according to different dimensions of impact. It could be climate change, the so-called warming potential, could be impact across global goals, such as the SDGs. In our case, this is called Globalance footprint, and then also a key number computed by assessing your investments against relevant megatrends. And what is key, and you might have an interest to explore this afterwards, it's open source, so it's non-commercial offering. We want to help the debate by making it more honest. A fun fact is we went not to the financial industry or the providers in the industries, we went to game designers and we went to data visual specialists to help us develop a platform which is engaging and which transports impact in a new way. The speaker before us talked about the flat world. In our case, there's actually a 3D globe on the platform, which you can zoom in and out, and you'll see where your investments have an impact on the world and whether this impact is positive or negative. But all of this is done to empower asset owners. We are used to make decisions in the supermarket, whether we buy a product which is cheap or we buy a product which has a more sustainable label. We might be used to using platforms when we select trips or hotels or restaurants. There's actually very little of this offering when it comes to investment. So we try to make it easy. And what I'm trying to advocate is that the interest in impact is not a special interest for a small group. It should be an interest for all of us, that we understand more what the interdependence between impact and risk and opportunity is. So this is basically, in a few words, what we're trying to do. And being a pure play firm, an entrepreneurial project, we founded it with our own money. There's very little conflicts of interests involved, and it helps to make the debate more robust.
Thank you, Peter. And just to make it very clear for our audience, where do you get the data from for your analysis and for your platform?
Well, that's the beauty of a newcomer. We basically can farm and scout the best data we find for any topic. So it could be that the data on corruption comes from an NGO, such as Transparency. It could be that we need a core set of more operational data, which could come as raw data from a more traditional data house. It could be that we find a data set from an academic institution. So basically we have multiple sources. We have roughly 200 different data points we build into our data stream and let our algorithm then do the job.
All right, great. Thank you, Peter. Now I'm excited to actually move over to Klaus, because Klaus is sitting in a company who is providing such data also for their providers. And you have been at Bayer for the last 10 years, and like 3 years ago started the sustainability department within Bayer. I think you have to fight internally, but also externally, still the reputation of Bayer and not having so much impact. So can you share with us what does it mean to you, ESG and impact, and what are you doing in the company?
Yes, thank you very much. And I'm extremely pleased that I have the opportunity to share our perspective today at this conference. For me, investor conferences or investor feedback is one of the most rich feedback we can give, we can receive and get, because I mean, we need calibration from the external world on what we try to do, and the reputational aspect clearly is one. When we started 3 years ago into the new, I would say, era after the acquisition of Monsanto, my team and we got the call to embed sustainability systematically in business. So it was a very impact-driven approach, maybe less a governance-driven approach, but more an impact-driven approach, because the first big question we had was like, what are the big tickets which we need to look at? And every big change starts with an acknowledgement, and we had to make quite a number of acknowledgements. I shall say, when we looked at what we have done in the past, even in both legacy companies, we have done a lot in the area of sustainability, but it was never systematically connected to business operations. And if it's not systematically connected to business and strategy, then it's not scaling up to impact. So we looked at where we are, and we clearly figured out that one of the key things which we need to address is food security still. It was always a key topic of our industry, but I mean, we need to address much more the need to produce everywhere in the world, and not only where there's already enough food, where there's already enough feed even. So we came out with one clear commitment to make it tangible, measurable, and transparent. And that was to have 100 million smallholder farmers in low and middle income countries in the next 10 years going forward. I think 100 million being quite a significant number. The other and even bigger acknowledgement which we had to make, and I think there we were not very powerful in the past, was clearly to say, yes, I mean, agriculture impacts the environment. Agriculture has a correlation to climate change. Agriculture impacts biodiversity, and we need to reverse these trends, or we need to make our share. So finally ending up in an equation which we call the paradox of agriculture. We need to help to produce more food on the land available on the one hand, but at the same time, we need to improve on preservation. And on the preservation side, we also derived two commitments in the beginning, which I think were significant. It was on the one hand to say we want to reduce greenhouse gas emissions on the fields of our customers by 30% globally. And we also want to reduce the impact of pesticides on the environment by 30% globally in the next 10 years. You may say, well, 30% less impact of pesticides is not enough. And I would hear you. I would even expect to hear that. But it started with the acknowledgement that, yes, crop protection has an impact on the environment, and we can systematically reduce. And in the end of the day, nothing of this ever makes sense if you cannot embed it in a business model for growers and farmers that they can adopt to transform it into business, because otherwise we have nice talk and no adoption. Now it's 2 years later, or 3 years later when we started, but 2 years later after we published those commitments, and I'm really proud to share that we made significant progress. And one of the progress areas where we are is that we have launched climate smart business models across the world, in Americas, but also in Europe and even in India, where we start to incentivize farmers for moving to climate smart agriculture, to sequester carbon, to avoid carbon emissions where possible. And I think that's the cracking point for us, is to find where we see the opportunity to turn new sustainable practices into business opportunities for the grower and for us in the end of the day. We are confident that we can also significantly further reduce impact of pesticides without losing business, actually, because I believe the future is less an input than an output driven. And in the end, what counts is what the farmer harvests and how the entire ecosystem looks like, and not how many tons of pesticides he used. And on this journey, I think we have come quite far. The industry has partly joined us on that trip. So some things which 3 years ago sounded like revolutionary today are quite common. And maybe the last word on what Peter said, for me, it's all about being transparent. Whenever we would design things which are buyer internally designed, like measures, KPIs, verification systems, and they are just buyer, it will never be trusted, it will never be adopted. So we need to collaborate with a lot of partners, and we need to evolve those models in a very collaborative way. And regaining trust is a long way to go. I can just share that I'm confident that we have at least started the journey.
Right. Thank you so much, Klaus, for sharing those insights from a really big listed company where you are really also pushing for impact and not saying like, okay, let's just be happy with we are recycling our waste and have like with government's policy, but you're really pushing for like what buyers actually doing and creating an impact. So, but with that also as buyer, for example, or any other public stock, I want to move over to Peter. And we had several conversations about that in terms of having impact at all as an investor when investing in a liquid portfolio, like listed stocks or bonds. I think a lot of social entrepreneurs are in the room today, and there I think it's really tangible often to see like what kind of impact the social entrepreneurs are having. But for you as an investor, I guess often it's a little bit harder to see what kind of impact you can have with public equities. So what is your personal take on having an impact with stocks?
It's a direct question, but possibly for people to understand where I come from. My professional hat or our company hat is we are a private entrepreneurial impact investor. I don't have to ask anyone what to invest into. So we go 100% impact according to our own definition, obviously.
Before that, actually,
yes?
Do share that definition, please, with us. How do you define impact?
Well, there are different it's not the thing is we are in the new areas and we're coming from an old system and we're going to a new system, but we use old words. Everybody say, well, impact is a word that everything has an impact, whether it's good or bad, so forth. It's clearly about investing to have an impact. It's not to invest in something that already has an impact. The money that you put in has to create a new additional impact. And it's not just any kind of impact. For us, it has to be a massive, at least transformative, if not disruptive way to change a challenge that we face. For us, what we choose are, to us, world-class solutions that haven't been there before. I don't know whether that already answers it.
Good, but like now maybe coming back, like your take on when you're investing in public equities.
Oh, okay.
Because that's also part of your
portfolio.
Sure.
I'm guilty of. I've been on the dark side. So I've been at Wall Street. I've done equity trading and quantitative analysis, and it took a couple of years until I realized that I was on the wrong side. So now I've left it all behind. So I'm kind of a free bird, and it's easy for me to talk and say that to me, impact investing excludes to invest into listed companies at all or listed bonds, because that's just the secondary market, and it's just trading places or money is just changing hands, and it's easy also to quantify. If you look at the investment or trading volumes at any exchange and compare it to the money that really goes into a company via IPO or capital raising, the trading volume is 100 times or even sometimes even larger than the capital that moves into the real economy. So you only have an impact of, on average, 1% of your money if you go into listed stock or bond on average. And whether that money then actually that comes to a company or to a project is allocated to create new additional sustainability, that's another layer that you have to look at. So when we look at projects and we don't have a realist, we try to go in and we are opportunistic, and we look at only at the impact first. Is it something revolutionary? Is it something really great? That's one criteria. The next criteria is to see, is the project owner or the inventor or the person who drives this or the people who drive this, do they do this for a purpose or do they do it for the money? Clearly, they have to do it for a purpose. And so we call that purpose alignment. It's not just between us and the project, but also with possible shareholders in there. It's just my personal experience that if you have a shareholder that comes from the old economy, he can be a pain, to put it like that, and that can destroy an impact project if you have somebody that just looks on the financial side. So we make sure that there are good people finance that.
Yeah, so Peter, so you're really an individual investor. You say like you are investing across asset classes, right? But really your focus is on direct investing because that's where you see you can have the most impact.
Entrepreneurially, and it's not just me. I have a team that are great people, and they correct me. I go in as blue-eyed as I can, being born Swedish, and then my own training, but also my very critical and well-educated team, they challenge my view on this, and then we take it further. Then we look clearly. A project must be profitable for us to invest into, or we make it profitable. Otherwise, it won't sustain the sustainability we are trying to create. And the last, one criteria also is that we can add value. Can we add value to this project? Mm-hmm. And we do that by impact management, being an impact guardian, what we call it, and also possibly getting other impact investors to co-invest into this.
Okay, thank you. So yeah, I would love to have a little bit of a discussion also on the panel because maybe some have a different take on that. Like you really focused on like direct investing and having the real impact there. For example, Peter, you're also investing in for your clients across asset classes. What is your take? And investing in liquid or stocks and liquid bonds.
I can very much agree with what has been said. I think it's not a question of either or. If you look at systems and how innovation and this type of disruptive development of new solutions happens, you always need the different players in the field, and that means different asset classes, and that means different times on the theory of change when you deploy capital. So in our case, we do that along this value chain. So in a normal mandate, it could include less liquid investments. And then it could also have, because of its diversification, a quota of listed. And so it's a question of being honest about the theory of change for the different asset classes. If in liquid, I personally happen to disagree with the academic world who basically dismisses this entirely. My professional experience has been, and I brokered investor-led dialogues, for example, in the pharmaceutical industry or in the finance industry, that as Klaus said, actually investor relations chief financial officers tend to listen to investors once you're invested, and we had a share of voice, and we can actually pinpoint the change we affected at the time, and we try to do the same now. But we should not claim that on the secondary market it's the same theory of change. Obviously, it's a different mechanism to have influence. What I advocate is a consistency in interest and a consistency in approach across every asset class. And if you look at the scale of the global challenges and the scale of the transformation needed, we know that we also need the listed world to scale and deploy and then take the innovation which comes from the incubators and from the venture capital world and the private equity world and take it further. So it's not either or.
Thank you for sharing that. And I have one more question then, but I also want to make sure that your questions get answered. So if you're online, feel free to send in your question via Slido. Also here in the room, you can already prepare your question. I would have one more for Markus, because Markus, you also mentioned like this 60-40 split. I'd like how are you applying an ESG lens, maybe and also an impact lens to what you are looking at? And like maybe also which data are you using to evaluate it?
Yes, I agree on the definition of impact investment we have heard before. Three criteria: additional, measurable, and a purpose. Yeah, so this is the abroad. It's the frame. But it's for private equity. It's difficult because at the beginning of a company in the early stage you can't measure the impact because the people have other purposes, other things to do, other priorities. So we solved this problem with the committee. With the committee, let's say with the stomach, the committee members make the decision: is this company, is this investment generating impact or not? Until now, maybe we can change if we get data and other things in a later stage. And I would like to add what said before, that and I think we agree on that, our definition is not the mainstream definition of impact investment. And now the discussion is going on in the financial industry because there is an European Union regulation on taxonomy setting up or setting in force, and there you have different articles, and I think we will have a much lower, let's say, definition on impact investment in the market as we in this room or in this society think on, and this is a pity. And the example of Bayer and Monsanto is very good because it's a very difficult topic. What you said and what you are doing is very good, yes. But the business case of Bayer and Monsanto itself is difficult. Yeah? So you can. It's a stock listed company. So you see the problem. We are founding member of shareholders of change, yeah? And for the other 60%, we try to do very active engagement, and we have discussions in these topics, and it's not possible even for a small group of discussion members to have one point of view on this whole story: ESG, engagement, impact, and everyone itself, every investor still has to make, and for a long time will have to make his own, let's say, definition, his own criteria, how to solve the data and the definition question.
Right, like it's really, important to think about like what kind of impact do you want to have, but I think in this panel what we want to bring out is really like ESG is not impact, right? So we shouldn't dilute that. I think that what was clearly said, I just wanted to restate that. And also, as Charlie said yesterday, are we at the peak at greenwashing right now? We don't want to do that. That's also why we put that panel together from different parts of the industry to really see like, okay, how do we see the differences, and to also bring out this message into the world, like that there is a difference.
Maybe can I just add something?
Please.
One important thing, I think, when it comes, and Charlie put it yesterday in a very good way, saying we need to be part of the discussion when it comes to the definition of impact. It cannot be that I would say the mainstream right now, who is not really deep into the impact field, is starting a conversation about how to describe impact and how to set the criterion of impact. I think there are two things, and both Markus and Klaus mentioned, and also Peter. Transparency, the data, the measurement, it's also very important when it comes to impact, but all about the discussion is about engagement, because we cannot change the business model of large corporates in a very, I would say, short time. But what we can do is really to help and discuss what's the future. how can it look like? How can we drive the impact? And very important for the community where we're coming from in order to get mainstream is to be part of the discussion. So you cannot keep it to the people from, I would say, the traditional investment portfolio management to describe or actually to define the areas of impact investment. So it's up to us to demand to be part of the discussion in order to avoid what Charlie yesterday mentioned, the part of greenwashing. So saying I'm an ESG investor and I'm picking up where my impact is and I have a wonderful impact report. So and that's why I love working with Toniic, because Toniic, you cannot say what you would like to see on your impact report. You cannot define your weightings. I cannot say I like to have 60% environment and social and still I can have oil and gas and still I'm an ESG A-rated investor. So you need to find the right participants for the discussion to have a standard on the market when it comes to impact and what is impact, what means impact.
Yeah. Thank you, Angelika. Klaus, are you feeling that engagement from the investors? Yeah,
yeah, we definitely feel that engagement from the investors. I wanted to make a little comment on the complexity of what is the right impact, because there are trade-offs. And that's something that we face at the moment, and it's not always easy to say, you know, on the one hand, we say we want to preserve land, we want to preserve nature, we don't want to convert more nature into agricultural land. And I believe that's absolutely true, because that's one of the key issues of the loss of biodiversity. But that means on the available land, you need to produce enough. We would call it sustainable intensification. There we already have a lot of disagreement, people having very different ideas, and we need to listen. And I want to give another example, which is even more crisp. I like it a lot because it shows that there's not that one single way to create the best impact. If you go to India in the traditional rice growing, it's called paddy rice. The rice is grown in wetlands. You need a lot of water. In some areas, there's enough water. In other areas, there's water deficiency. And that's a problem. It doesn't work with the traditional way of growing the rice. And there's a second problem, that in this water, tremendous amounts of methane, of a greenhouse gas, are formed and released into the air. So there's actually an issue with the traditional way of growing rice. If you would move now from that paddy rice into dry-seeded rice, you would reduce greenhouse gas emissions in a very significant way. It's significant. It makes a difference. You would also save water where it's needed in some areas. But the water works also as a herbicide. It takes down the weeds. So that's the trade-off. If you want to move out of paddy rice into dry-seeded rice, you may need to apply herbicides. And I don't say that's the right way. I just want to put on the table that there is not that single impact. There are different types of impacts. And in agriculture, whatever you change in the system, you touch on something else. And that's why I believe the only way to go through this is the open conversation, and you will have different conversations in different regions, in different countries. The way is not to say we know what's right and wrong from my perspective, but I just want to say what's the right impact is not a very easy question with a single answer.
Definitely not. Thank you. I think that also came up yesterday in the impact management and measurement panel, that really it is a complex system and you have to look at different angles. And unfortunately, like in the traditional finance world, you have these two metrics, risk and return, and with impact, it's not that easy to think about it. So yeah, thank you for sharing it. I do want to make sure that if there are any questions in the audience, that we do get them answered. So seeing, does anybody here in the studio have a question for the panelists? Yes, please. Do we have a microphone? It's just 1 second. Coming.
I wanted to address, because I've heard quite a bit of terms being thrown around these last couple of days, and it's very fascinating. Systemic change versus direct impact, systemic impact. How important is this systemic impact to investments when you guys assess a revolutionary impact? With these words, is systemic impact important in that decision-making process? Also seeing that systemic change is probably also longer-term change that yields results possibly years down the road, if at all, versus a direct impact that might produce some results here and now. How is that from an investment side? What are the variables that you use with systemic change versus direct change to assess viability?
Who wants it?
It's to anybody, actually.
Peter? Yeah.
Surely. That relates to what I wanted to say also, and to put things in perspective, because I'll be provocative. I don't believe in measurement. I think the regulatory framework of the EU is counterproductive. What I mean by that is we clearly have to rebalance mankind with nature. Otherwise, it's not nature that's at stake, that's mankind that's at stake. The SDGs is a nice goal or a step in between for 2030, but it's just not even halfway or where we have to go. And we are already 6 ways through, and we have 9 years to go if you live by that schedule. And we have not come far at all. There is, and I'm coming to your question. There is something that's called sustainable finance. I mean, there are buckets. I don't believe that the world is gray. I think it's very colorful. Too many colors to put in words. And there's a measure, one estimate is that about 4,000 billion or 4,000 Milliarden of US dollars went into sustainable finance in 2018-19. And the UN estimate is that we only need 2,500 billion or 2.5 trillion US dollars to reach the US goals annually. So it seems like we are on track. But over 95% of this money goes into listed company or ETFs. I mean, that's perfect. It doesn't help or do the impact we need for the sustainable goals at all. Engagement is important. And sadly, the most important SDG, number 17, is number 17. So people look at this as it's not important, or it's the least important, or the climate change SDG is down number 13. Yes. So it's the wrong perspective. And having Article 8 and Article 9 with a low standard, and people saying they qualify with a fund in listed companies for Article 9, it's pathetic. It's not helping. So it's what it's doing, it's misleading or misdirecting the capital that's willing to help and change the world into the wrong direction. So systemic change and systemic impact change, yeah, that's something we look at when we estimate it, but there is no framework for it. There's nothing to compare with. It's pure experience or intuition to start with, and then to see, can this work? Can this change? I mean, how do you want to? We have one project that saves 3 species from extinction, and it's one that's very powerful medicinally and culturally. But how do you want to estimate that in carbon credits? I mean, and that's the point. Having those medicinal forests, which we have, we can have carbon credits. We can measure how much carbon we sequester, but that's the least criteria that's important for that project and investment. So people focus on the wrong things when you measure, and things that really matter. Also, I'd love to spend hours with Klaus to understand more his approach, because I'm really engaging in regenerative agriculture and alternatives. What is important to focus on? How can we measure something? How can you measure biodiversity? That's a discussion that's been around here, and that's a big challenge. It's even more important. ESG and impact, yes. ESG is good and nice to have. It's about how do we behave personally or even as a company in the footprint for the future. But we have an industrial area of, let's say, 150 years that have almost destroyed environment and also the social interaction between people. And to remedy that, you need to have other solutions as well. And I mean, there's a big space for everyone to do something good. And I'm just going to quote another member of Toniic, and she says, for her family office, there are 3 buckets. And when she came in as a new generation, there was only asshole investments. And she moved into non-asshole investments, being ESG. And now she's looking at impact as well. Another way to put it for us is it's good and right to stop using plastic cups when you drink coffee or plastic bags and all that stuff. And it would be a great impact if McDonald's would change their packaging into something that's fully biodegradable. On the other hand, we are looking at a project that's going to clean the oceans from the from the plastic in a nano size, even in deep waters. It works technically, but if that's being financeable, that's going to have a huge impact that dwarfs ESG. So ESG, there's another saying called somebody else. ESG is for losers if you want to do impact. I mean, that's provocative and arrogant, but I want to fire it up.
I like having some provocative statements for that. Yes, thank you for
Can
sharing
I
that.
jump in?
Did I hear something? No.
Can I jump in?
Yes, please, Peter.
Well,
Peter.
just briefly, I'm in year 30 of my professional work as an entrepreneur campaigner for sustainable development, and clearly we haven't succeeded. So the question for systems change is absolutely relevant, and what we have done for the past 30 years is incremental progress. And I fully agree that investing into ETFs is highly problematic, not just because roughly 30 or 40% of the capital deployed in ETFs in the market is actually damaging, not just neutral capital deployment. And I also agree that as much as we might need a regulatory framework for a lowest common denominator, the approach the EU has chosen is problematic. It's a bureaucratic monster which is probably going to sink itself. So yes, we as investors, we really need to understand what is needed, and it's systems change in a radically different way as we saw in the past 30 years. And that also brings with it that you need to break with current industry standards, current ways of looking at the world. I'll give you an example. In agriculture, if we want to see a massive reduction in energy, in water consumption, in deployment of fertilizers and pesticides, we will probably need better data, and that needs database providers, that needs GPS linked to much more precise soil information. Suddenly you have a software company as part of a major player in sustainable agriculture, which would never be qualified as Article 9 or Article 9 by the EU. So yes, I think that we share the skepticism in that space. So it requires, on the other hand, that we spend 90% of our time in understanding what is the transformation going to look like, what is needed, and who is out there deploying the innovation and the sort of changes in business models and changes in policy frameworks and changes in solutions. And that really shifts the emphasis, at least in our case, in deployment of our capacity. It's 90% forward-looking and 10% historic data, as opposed to probably the other way around in mainstream finance.
Great. Yes, Klaus, one more addition.
Yeah, super quick. just to spread some words of optimism in the rounds, the first thing is that I absolutely believe that the future in agriculture, business model-wise, will be output and not input related anymore, and that is data-driven. So I think in that logic, inputs will turn from value into cost drivers, and there will be an economic drive to reduce inputs. I think that's maybe something positive to say. The question on what does the outlook have to look like? What is the desired outcome of that? That's something where I really agree. We are not there yet. At the moment, everybody jumps on carbon. I think that's just one piece of the whole thing. We would like to see a farmer. My dream is that a farmer is incentivized for running the perfect ecosystem, encompassing biodiversity, soil health, water purity and water quality and quantity, and also, of course, greenhouse gas emissions. I just believe that if you start from the maximum complex system, you will never get there. That's why we want to build it like building block by building block. That's the approach that we are trying to take at this point of time. But for any step we take, we need the critical feedback of you and many others, because if it's just an in-house invention, it's not going to fly. I just think that we are moving towards that ecosystem incentivization for a farmer. So there is a regulatory part, there's a political part, there's an innovation and technology part to it. And of course, there's an agreement part on what's the data to be captured, what's the right way to measure it. And it's a long way to go.
Right, thank you for sharing it, Klaus. And I just wanted to come back to the question around systemic change and like systemic investing, to share my experiences from working with the Toniic investors. So many of them are actually using a systemic lens to really like look at their portfolio and think about really the whole system, mapping it out, like who are the different stakeholders and what are the kind of investments they may need to do, but maybe also what kind of actions in terms of engaging in it. So really applying the systems lens a little bit more is something that we are seeing more and more coming in, and that goes beyond like ESG and impact. So I just heard that unfortunately we are coming to the end of our panel today, but I want to close actually with a question for all of you. So we have talked a lot about ESG and impact, heard different approaches of like, okay, don't want to do ESG at all, or like, okay, ESG needs to be a part of the portfolio. What would be a recommendation or lessons learned you would like to share with somebody who is thinking about this ESG and impact? Angelika, may I start with you?
I think the lesson, I would say lessons learned, we're still learning, and it's not stopping. What I really would like to see is that the improvement of adding the impact thought in the investment process. So we see a few of the players and also in Austria. So I'm very glad that I see the movement also in Austria from institutional investors. But I would love to see that financial analysis, ESG, and the third pillar should be impact. So that this is part of the traditional investment process. So it's not like I have a proportion of my portfolio into impact. I would like to see it about the entire decision process that impact plays a role, because as we said, our aim is to create the impact economy, and an impact economy means a balance between profit and impact. And I can only reach the balance if I consider my impact targets at the very beginning of my decision. So somehow this would be, I would say, the goal or the wish for the future of finance, that impact is at the very beginning of the discussion and not then when it's driven by either engagement or, and I have to say, thanks to Future for Fridays, right? But typically, I would say it's the responsibility we have to take, and impact should be at the very beginning and not if it's, I would say, necessary or if we have no choice.
Thank you. Markus, what would be your recommendation or maybe also wish for the future?
Yes, the wish would be that we keep the aims in our brains and hearts, because the discussion is becoming technical. We are not discussing about the millions of people who will lose their homes because of the water is coming up. we are talking about 1.5 or 2 degrees warming up and not of the social problems that this is creating. And I don't think that we are in track and in line, looking at the news every day, seeing the fire and the water and all the other problems. And I think to measure impact is very important, coming back to discussion before, because we are talking about investments. And investments create yield, and they have risks. And so you have, on the other side, you have to show what is the impact you are creating. And yes, so keep the aims in the brains and in the hearts.
Thank you. Maybe finishing around here in the studio, Peter, what would be yours?
Okay, again, being less provocative, yes, it's good if you can measure things and quantify it and communicate it, but it has to be payable. But I mean, CO2 is one thing to monitor, especially in industrial solutions, but biodiversity, there's no standard, and it's very complex, and it costs money. Now, I don't fully agree to balance between impact and profitability. I used to say that. In my experience now, what I experience, the more I focus on the impact and the better the impact is, funnily enough, if you do it right, entrepreneurially, the profit comes by itself, almost not by itself, but it comes as a side effect. So we see double-digit returns, and we don't have to be ashamed of it, because it's not by taking away something from someone, it's just by doing a great job in impact. Just words, but I'm trying to put this in a short sentence.
Thank you, Peter. And bringing in Klaus from Germany, what would be your recommendation, maybe, or wish?
I just want to say that there's many people in Bayer who have a real passion to change for positive impact. And that is giving me a lot of energy, to be honest. So, of course, there's also resistance, but there's a lot of power, and people want to do things for better. And I think that is what makes a difference in the end. ESG for me is more, I mean, I'm an ESG student, not a master at all. But for me, that's a prerequisite, but that's not what makes the big difference. The big difference is the impact. I agree with Angelika.
Thank you. And Peter Zollinger in Switzerland, last words to you.
Yeah, I would have a recommendation for asset owners and a note of optimism. The recommendation is insist and engage your advisors constantly on what the economic, societal, and environmental impacts of all your investments are. Insist on receiving transparency and accountability, and don't confuse this with an ESG rating fact sheet, which is incomprehensible and not really meaningful. So much more pressure on the industry to be transparent. The note of optimism, I also don't believe in measurement. I tend to say that we need to be correct before the comma and not after the comma. And I have experienced that many of these topics, when you actually have to assess systems change and have assessed particular investment opportunities, if you deploy a consistent framework of global objectives and then use heuristics, proxies, human common sense, you come a long way. Don't wait for precision or models that would be too late.
Thank you, Peter. Yeah, I can fully underline that. We also saw that really from our Toniic members, that the pressure from the asset owners, from the clients to the advisors, that does have an impact and also make them move. So my wish is to continue having this conversation to make sure ESG and impact is clearly understood. For me personally, it's an and, but it's not the same. So thank you so much to my panelists, Peter, Angelika, Markus, Klaus, and another Peter in Switzerland. Thank you to your audience here. Thank you to the audience online. And I think we're going into a little break now. Wonderful. Thank you, and then we'll be back.